You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the premier options education program. Yes, that means it's time for Education Wednesday. It's time to get the party hat on. It's time to have some fun out there, learn a little bit about the old options. All you pro folks, surprise, you're getting a double dose of the old OBC this week. So last week we gave you a doubleheader. You guys on the pro side already heard the second episode. Hasn't hit the network yet because we're doing two more coming at you today. We must really love you folks. 4 boot camps in 2 weeks. Also because my cohort, the black-hatted one's going to be doing a little bit of traveling, has his big retreat coming up. So we need to do a little bit of coverage there as well. But all you cool pro folks have already gotten access to all that. Also gotten access to not just a great pro Q&A that we did this week with Mr. Simon Ho, the creator of Spikes and BitVol and a whole bunch of other great vol and crypto vol products out there. You also get Options Oddities. You're getting, of course, as we speak, you guys have already received a lot of the great audio we've recorded from the OIC conference that's going out there to you folks first. In fact, some of it we have to change for what goes out to the network. So you folks on the network are not going to get all that good stuff, but on the pro side, you folks already have access to it. So where do you go to get access to all that good stuff? Engage with Dan and myself live for this show and every other show we do here on the network. Bunch of other exclusive shows. Mountain. I'm looking at it right now. I came back from OIC listeners with a mountain of goodies in addition to the mountain we already had. So there's a lot of great stuff here we're going to give away to all you folks. How do you get access to those giveaways? theoptionsinsider.com/pro, or for you cool kids, /secret club. And of course, however you listen live after the fact, we do ask, if you like what you hear, if you're on the on-demand side, that you keep rating and reviewing. It does help the new folks discover the show. Just like our listener did this week, it came from Ignacio. 5 stars from Ignacio. He says, I'm new to this stuff. I have no idea what these guys are talking about. ... Yet. But I'm enjoying it, and I'm starting to learn more. Highly recommend. Well, thank you, Ignacio. I highly recommend your review there as well. And joining me to bask in the glow of your review, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring, the author of 1 or 2 or half a dozen options-oriented tomes. Mr. P, welcome back to the program. What do you think about Mr. Ignacio? He doesn't get it yet, but he's starting to, sir.
Hey, man, you got to start somewhere. Nobody gets everything, totally right off the bat. So take your time, my friend. Stick with it and learn through repetition, and we're going to like hanging out with you.
Yeah, we're kind of fun guys to hang out with us. You get to know us. Maybe not Dan so much, but you get to like me. I can be pretty fun. Dan's an acquired taste, so to each their own out there. Mr. Dan, how are these crazy markets treating you in MTM these days, sir?
Whew, man, it's exciting stuff these days, isn't it? Our students are, they keep moving forward. The ones who, just take the bull by the horns are doing that, and they're pushing forward, and, it's exciting. the more you learn, the more you earn. And in a year like this, you buckle down, you put in your time learning, and it makes you a better trader, man. Who was it? Sartre that said that which doesn't kill me makes me stronger, right?
It was appropriated by Stalin, so he liked that saying as well. So a lot of people use that for different means to different ends. As we keep on rolling, let's see what means we have in store for you today. A little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
And yes, it was Nietzsche, of course. Friedrich Nietzsche, who came up with that one. Even though I do believe Stalin and a few others, maybe Hitler, liked that one as well. But I digress. This is not Dictator Cast here. Even though that'd be a fun show to do here on the network. Nope. This is Options Bootcamp. Today we're going to go to a little bit of options drills, talk about a little bit of kind of how these crazy markets may be impacting you. Dan, this was kind of your suggestion for a topic this week because, as I mentioned at the top of the show, there's a reason why I tossed it to you about the markets right now. We are seeing, some might say, capricious, crazy markets going on out there. We're rallying hard to the north, then it turns around in the same day, and then we're closed the day down. We're seeing nearly 4% sell-off some days, and the next day we rally, then we sell off, then we rally. Huge whipsaws, huge intraday swings. So there's a lot going on that could be intimidating to the new options trader. And also, it's a topic that a lot of options education doesn't want to touch on, and a lot of people try to pretend doesn't exist or isn't really a factor when it comes to successful options trading. Those who've been doing it for a while know that isn't the case. It is very much a factor in a long-term success of options trading. And Dan, that is a little bit of the old four-leaf clover, a little bit of the old luck of the Irish when you're trading, sir. So what are your thoughts on luck and the role it can perhaps play in your options trading, sir?
Mark, this is a fun conversation because, a lot of folks do attribute it all to skill, especially when they're winning. And when they're losing, it's always somebody else's fault.
So you're saying all those people who were just meme call Palooza in last year and making a fortune, that was all skill, sir?
Exactly. Just ask them. No, but, just like a lot of endeavors, it involves both luck and skill. I mean, we could go through many, many examples, and I feel like throughout the show we probably will. But, anybody who's ever been really successful at anything is going to, as long as they have some amount of humility, they're going to tell you there's some amount of luck and some amount of skill. And depending on what sort of endeavor it is, sort of determines what that mix is.
Yes, there are many examples where we can talk about the impact of luck on trade. I have a very recent example I can bring to mind. We do a lot of live trading on our Options Oddities program every Friday. Again, that's for all of our pro members on there, where myself and the Rock Lobster are always talking each other into one crazy trade or another. And lately we had our eyes on a lot of these beaten up names that were high flyers in the meme stock era, so your Palantirs and your Robinhoods that have now come under fire. And we were identifying different fun trades out there, 1x2 type put spreads, and also sometimes just straight up short puts going into some of these big announcements for some of these names. So we had identified some good levels that we thought. In Robinhood, we were getting 70 cents for the 10 puts going out only a couple of weeks. That was an attractive level. I myself didn't mind. One of the first, obviously, risk management steps you can do with selling a put is to be comfortable buying the stock at that level. And I didn't mind buying Robinhood at the equivalent price of about $9.30 because for all the reasons we've talked about, many have talked about out there, that it's probably a takeover target somewhere around that level or a little bit below. In fact, we did see someone come in and buy a bunch of the stock when it hit the 8 handle, so that was a good sign that people are intrigued by it. And also, we sold Palantir, or at least I did going into the earnings. He had already had a position on around the eight puts and getting up. Actually, no, they were the 8 half puts, getting nearly $0.50 for those as well. So they both seem like very attractive levels, names that hadn't really been below 10 much before. And then lo and behold, the swings of the market come in, and both of those trades, they were very short-term trades. I like to keep my short premium trades very close to the fire because I don't want to go out too far and be stuck in a trade. I like to be able to roll or adjust or get out of it, live to fight another day, and maybe readjust if I want to. And so both of those trades were almost immediately several dollars in my face within a couple of sessions. And I was looking at it saying, okay, I'm going to have the stock put to me. I didn't mind both of these levels. Maybe my Palantir level had been changed by some of the recent announcements that they weren't exactly getting all the government contracts that we had thought, or probably were assuming they were getting. But I was planning to probably have to wheel out of some of this, maybe get some covered call premium and slowly claw my way back to kind of that break-even level. But I didn't mind having the stock at those levels. That was my plan going into the show on that Friday. And then, of course, on that expiration day, the market gods smiled upon me. We saw a huge rally on that Friday going into the expiration on my options. And both of these positions rallied enormously. I ended up keeping all of the 70 cents that I sold the puts for in the Robinhood, and I ended up being able to scratch the Palantir ones, which were looking the worst for me. And that was a winner because they were more than $2 in my face at one point as well. So sometimes, Dan, the gods giveth, and then the options gods taketh away. In this case, they smiled upon me, sir.
Yes. Oh my goodness, that does happen. Man, oh man, oh man. Just kind of to go to broaden the conversation just a little bit more, like people often make the analogy of trading being like gambling, especially people who like are not into trading, like, oh, that's just gambling. And I don't know if many of you know this, but I used to actually work for the SIBO after I traded at the SIBO. I used to teach classes for them. And when I would give presentations or put together PowerPoints, they would all have to get run through compliance through the lawyers. And oh my goodness, if you ever said anything comparing trading to gambling, they would like you'd have to run for the hills. Like, oh man, they would come after you. But, the truth of the matter is there are some similarities, but, like a very, very simple gamble, something like roulette, where there's almost no skill involved. And I say almost because I've got stories on that, is probably not much like trading at all, unless you don't know anything and you are just gambling. But I would say trading is a lot more like poker, which is also a game of luck and skill. Luck is the stuff that you can't control. You can't control what cards come out, but skill is how you play those cards. And, it's not just like an amazing coincidence that at the final table of the World Series of Poker, you tend to see a lot of the same people back there. It's not because they're the luckiest people in the world. It's because they use their skill to navigate this game of luck. And option trading is very, very much like that.
Yeah, there are many ways that, luck can strike, even if you're well planned. We've said many times, and we'll get into some strategies that maybe make you a little bit more prepared to deal with the whims of the market and make luck be on your side. But look at 9/11 as a great example. A lot of people were doing their normal thing on the trading floor back then. They had their delta hedge, delta neutral type positions. They felt like they were fairly safe. And then, of course, you have an unforeseen event come through, like a world-shaking terrorist attack. And what happens? The exchanges, the markets are now closed for the longest period since the Great Depression, pretty much. They were closed on 9/11. They didn't reopen again until pretty much the next week. So you went through a whole weekend, a whole massive market crash with not much at all you could do. So that was a scenario where luck was working against you. People were worried it was going to roll through expiration, which would have been exponentially worse. Then you would have had, of course, underlying positions, hedging your options positions, your options going away, still having the underlying, so having huge unanticipated delta exposure. Luckily, didn't get quite that badly, but that can show you just the roll, the whim. Another example of good fortune. I closed out my position. I had a big position in Intel not that long, maybe a few weeks before 9/11 hit. I was moving upstairs. I was closing out that stuff. I said, I'm going to sell out this position and close it out and migrate to do some other things. That was kind of the tail end of my floor trading time down there. And that was just, again, kind of the capricious whims of the gods. If I had kept it a couple of more weeks, it would have been an entirely different story. Very difficult to unwind, very difficult to deal with all the unanticipated risks that the macro markets threw at you. Again, in an event not of your own doing, no control you had over it. These are just the things, the winds that could buffet your portfolio if you're not prepared. So, Dan, let's talk about that preparation for a little bit. Obviously, you're training a lot of people over there at MTM. What are some strategies or some rules of thumb or some just tools they can keep in their back pocket to, obviously no one can control luck, but to try to make luck work more in their favor, sir?
Man, well, I will say for sure that, oh boy, there's probably a million people attributed to this saying as well. Probably some dictators.
Is this Stalin again? Are you going to quote Stalin to me again here, sir?
But, they say you make your own luck. And I'll share two stories about luck and then tie that last statement into those two stories. And this one I think I might have told on a past episode before. It's just the one that comes to mind. I don't know if it was my biggest lucky win, but there was one day when I was really running late and I made it down to the trading floor, like right before the bell, snuck in right before the bell, grabbed my, handheld computer and I look at it, I'm like, oh, crap, what's going on here? It's showing that I made, $20,000. I forget the exact dollar amount. Showing that I made $20,000. This is not right. What's going on? Oh, it's in Kerr-McGee. There's something broken here. Geez. Oh, my deltas are all super long too. What's going on? And I'm all mad. And then somebody hits me on the shoulder and says, hey, dude, did you see Kerr-McGee's up, 10% today? And I'm like, oh, wait a minute. Oh, that's real money. Oh, Merry Christmas to me in July or September or whenever it was. I just happened to have extra, positive gamma, which, if it was up to me, I would have not had because you have time decay that goes with that. But, magically just, boom, made some money, got lucky. It wasn't skill at all. In fact, I was trying not to have positive gamma and negative theta. And then the other side of that, you mentioned, 9/11. That was one where I happened to be short a bunch of downside puts. And, I didn't really think much of it because they were so far out of the money. But one was in Carnival Cruise Lines. The other, what was the other one? And that was a big fiasco. But I came in after the market opened and it's like, oh, I lost $320,000. Boy, I thought I was flat. I was flat deltas, barely any gamma or anything. But just a gigantic Six Sigma move like that can really wipe you out. So how do you make your own luck? Well, the second story especially, I tell all our students, look, close your puts and your calls, close all your positions, especially your negative gamma positions before expiration, because you never know what can happen. And people say, oh, pshaw, I've done this 100 times. And before 9/11, I did it 500 times. But, you make your own luck in not having that exposure that can be horrible luck. With the Kerr-McGee one, I don't know. I didn't really make or break my luck in any way on that one. Just took it and I was thankful for it. Just be humble, be thankful, and take what you can give and keep trying to control your profitability and your risk as much as possible.
Yeah, that control is a key aspect. Again, no one can control whims of the macro markets like a 9/11 or things, but you can do certain things to make yourself most easily prepared for it. One of the ones Dan mentioned is a very easy step. We've said it many times on this show and on the network. It may sound like we're, berating you on this or we're just dragging this out or belaboring this point, but there's a reason why we stress this. I've seen it. Dan has seen it. We've seen it come back to bite people many times. Close out your stuff before it gets to expiration, particularly if you're out there, you're selling a bunch of premium and it's worked your way, it's gone down to below a dime or maybe even a nickel. At that point, you are literally just leaving risk on the table for no reason whatsoever other than to get the extra few cents out there out of that trade. The costs are lower now, so any incentive you had to keep these things on, let them go all the way to zero. There's a reason why we've said this. I've seen people going into expiration, and all of a sudden something crazy happens. Again, don't leave yourself open to this. VIX is a great example. We've always cautioned many times, don't keep your positions open through VIX expiration. That is literally the definition of a crapshoot. You have no idea where those contracts are going to settle out. Equity options, something similar. If you have short, let's say, short call contracts above the at-the-money strike and you're going into expiration that day, you don't feel like closing them out. Why pay a penny to take them off or a few cents? Doesn't make any sense. They're worthless. How many times have I seen a name in the immediate after hours, after expiration, announce some crazy development? Maybe it's a biotech, they have a new drug, a tech name, they have a new announcement, and the stock gaps through your strike in the after hours, and contracts that you could have taken off for pennies are now worth many dollars against you. I have seen that many times. Remember, after hours, there is a thing. People can close out their positions in the hours after trading, and people forget that sometimes. So just because it closes and your contracts are out of the money doesn't mean you're safe, out of the woods yet. So spare yourself that risk. That's a very obvious way to put luck in your favor, is to close out nonsense positions and even your winners. If you don't want them to retrace against you, lose some of that, take off some or all of them heading into expiration. We've seen it many times. We talk about so much unusual activity on this network, and so many people have winners. They bought a put, the stock plummets. They bought a call, the stock takes off, whatever the case may be, and then they do nothing with it. And then it goes all the way back to expiration, and they give up most or all of their profits. And we've seen it time and again. People have given up hundreds of millions, billions of dollars at this point that we've tracked on just not taking things off. So close things out prior to expiration. Live to fight another day. Take your winners. Cut your losers. You'll live to fight another day, and you'll make your luck work for you. Another thing that we've talked about through hard-won wisdom on this show and on this network is the whole net short units philosophy. Now, we talked about this before. Don't be net short units. What the hell are we talking about, right? What do we mean by this? That means you don't come out and just, let's say, you're going to do a ratio spread where you're, let's say, long 1, short 5 on some call vertical or something like that. You're net short 4 units there to the upside, right? That's just nothing but risk. And, that's so attractive. It's costing me nothing. Maybe I'm putting the spread on for a credit. What could go wrong with that? Well, of course, you could blow through those strikes very easily. We just gave you some good examples. 9/11, crazy earnings announcements. Having a ton of net short units on, and it was very attractive in the meme stock palooza as well to come in and just blast away at a lot of those calls. Brokers awakened to that risk. They started jacking up the margin requirements as a result. Why did they do that? Because people were getting run over. There's a real risk to that. So if you're going to go out there and be net short units, remember, I gave some examples earlier selling puts. Those are obviously net short units, but those I had identified levels where I was comfortable buying the stocks. That's a little bit of a different story. And obviously, it's not unlimited risk. There's finite risk to that because the stock can only go to zero. Particularly on the call side, there's infinite risk. So if you're going to be net short units, we really counsel against that. Go for spreads, even level spreads, 1-to-1, 2-to-2, whatever the case may be. You know exactly what your risk is going into it. You know what your max profit can be. It's a much better scenario, especially if you're listening to this, or maybe you're not a full-time trader. You have other things going on. You can't babysit your positions all day. If you have crazy net short units everywhere, that can and will, witness Dan's example, that can and will come back to bite you. And when it does, it could be ruinous. It could end your trading career, end your account, lose your house, lose your kid's college fund. No one needs that risk for a handful of cents here or there. Mr. Dan, those are just 2 ways people can do this kind of stuff, is obviously close out positions prior to expiration and don't be net short units. What do you think of those? Any other tools you can think of to arm people to help them make luck work in their favor, sir?
The one thing that I am a super big fan of is looking at what I call sliding risk, which I don't know if we've ever talked about on the show before. But
is that when you go down the water slide and it's a little bit steeper than you think, you bump your butt on the bottom and that kind of hurts? That's kind of slide risk, I think.
Yes, it is. And also standing at the bottom of the slide, that's some slide.
Oh, that's risk. A big risk. Yes, that one does not work out well. Trust me.
Yeah, so it's kind of an easy way to acknowledge the risk of your negative gamma without even looking at the gamma figure. And it's super easy for retail. Well, depending on which broker you have, it's super easy for retail traders to do this. But I mean, I learned this little trick when I was a professional trader. Basically, if you go to, well, okay, so Thinkorswim is one of the brokers that I have accounts with. It's one of my top 3 favorites. But in that account, when you go to the Analyze tab and you're modeling out a trade, you can look at slices And that's sort of what they call these little points. You can set a specific, distance from the money, from the current stock price in percentage terms, standard deviation, or just pick a stock price and say, hey, if the stock moves 10%, how much do I lose? And if it's just more than you can stomach, which time to time it sure can be, you should choose to select a different type of strategy. Like if you're playing, you think a stock is not going to fall very much, you could go and sell naked puts. Or if you really can't stomach the risk, if it somehow falls 10%, which, as we all learned recently, a stock can fall 10% in a couple of weeks easy, overnight easy. Look at some of the social media stocks lately on earnings. Maybe you're better off doing a put credit spread instead, or maybe, something else that has less risk for that type of scenario. So that's what I call sliding risk. I think some other people call it that too, where you just look at, like, if the stock slides up or down, if we're talking negative gamma, it sure could be either. If the stock slides up or down a certain amount, how much do I make or lose? And, you want to be more concerned about what you can lose. And little tip, I typically set benchmarks at 5%, 10%, and 20% up or down. And let me just belabor this point a little bit more. When I've told some people about that, some of my students about that, they said, oh, Dan, you're like paranoid. I mean, if it starts moving against me, I'm just going to get out of it and take a small loss. That's not what I'm talking about. Like, yeah, of course, if it starts moving against you, that's what you do. But I'm talking about you wake up in the morning and boom, it's like way through your, it's 20% away from where it was yesterday, up or down. It really, really matters.
It does indeed, and definitely matters. Do not stand at the bottom of that slide. That's not a good slide risk to take, listeners. One other addendum I want to add to a way to keep luck, at least from coming back to bite you, is we talked about closing things out, and that if you follow that advice I gave earlier, then you should be insulated somewhat from what we're going to talk about next. But this is another important thing to keep in the back of your mind with the products you're trading to help luck not come back to bite you at the very least, which is to understand the dividend schedule of your product. You would not believe how many people out there this has come to haunt. Even in broad index products like SPY, everyone forgets that SPY has a quarterly dividend. And I don't even need to look it up anymore. When the emails start hitting the network, hey, what the hell happened to my SPY? What happened to my calls? That's when I know, okay, it's SPY dividend time. People forgot. So if you're out there, even doing basic stuff like, covered calls or short type positions, understand the dividend schedule for your name. It's a basic thing. But if you don't understand that, and all of a sudden you're heading into XDiv, and all of a sudden you're seeing crazy assignments happen on some of your short positions, you're like, what is going on? You don't know what's going on. All of a sudden you come in with crazy underlying positions after expiration that you hadn't expected. Don't put yourself in that situation. That is usually not an ideal situation to be in. Surprise and anything in your portfolio is usually not good. So insulate yourself against that. Do a little bit of basic due diligence. Know when your ex-div date is. For SPY, it's pretty easy. For some of these other names, you might have to dig a little bit if you're getting some more of these esoteric single names. But that's another way you could just take a very simple proactive step so you don't have these random, well, not even random, they're scheduled, but things you don't know about. These events that you are ignorant of come back to bite you at the end of the day. So Dan, we talked about slide risk. Don't stand at the bottom of it. Talked about watching out for dividends. Know the dividend schedule. Closing out your positions prior to expiration. That's a big one, listeners. Really take that to heart, especially if you're on the short premium side. And again, short premium traders try not to be net short units, particularly in the wings. We've seen crazy upside movements and crazy downside movements over the course of the past year. So we've seen very literal examples of what not to do in this environment. Another addendum maybe to that too, Dan, might be worth talking about. It's a very basic one right now, but we see a lot of people coming in towards the end of the week. They might see an interesting trade. Sometimes this bites me on options oddities because I have to do some trades late there in the week, late in the day heading into the weekend. Not my favorite time to put on trades, particularly short premium trades, because we have all seen that there is very literal weekend risk right now in the markets. We don't know what's going to be announced, what the Fed's going to do, what Putin's going to do, what's going on with monkeypox. We've seen crazy things unfold, and chances are they happen over the weekend. So it might behoove you, especially now, if you don't want luck to come back to bite you when you can't do anything about it because the markets are closed, then maybe keep your powder dry, or maybe be a little bit judicious if you're about to crush the bid on some short premium going into the bell on a Friday, heading into, this is a long weekend coming up, especially important right now. Then maybe you want to think twice about it. Am I really selling a good level? Am I really just giving away risk on the weekend for no reward? I'm really just selling Monday or Tuesday's level right now. They've already taken the weekend out. These are things to be cognizant of. Blasting away, putting on a lot of trades, heading into a crazy weekend may not behoove you at the end of the day. So, Dan, there's some very, very proactive tools and steps and techniques they can utilize. Don't be net short units. Close out your stuff heading into expiration. Maybe these days be a little bit more judicious heading into the long weekends. Understand your dividend schedule. Don't stand at the base of the slide. Dan, anything else you want to leave them with here as we're talking about the impact of Luxor?
Yeah, just, play it tight, and there's nothing wrong with, being a little bit paranoid, when it comes to trading. In fact, the more time you spend in the market, the more you'll see just crazy stuff happen. And, when you're brand new to trading and something crazy happens, you just chalk it up to like, oh, dude, I don't know, there's something weird happening. And maybe the market makers are playing games, but no, there's usually like, a mathematical options model reason or something for why that happened. There's like, we could do like 3 episodes on this, really flash story right here. Like, I remember a long time ago, I went to a water park with my kids when they were little, and coincidentally,
slide risk. Here we go.
Slide risk, right? Ran into a trader that I know who traded in SPX, I guess it was, because they have AM settlements on Friday, and I saw him on a Saturday, and he's like, "Oh yeah, man, I almost went out of business yesterday." He was a big trader, had his own little sub company. Yeah, I almost went out of business yesterday. I was like, why? He's like, well, because I went home flat SPX on Thursday and everything was fine, but Friday morning, did you see the open? And he's like, I lost $300,000. So, it's just like these little things. And yeah, oh man, I could probably come up with 10 examples of just like weird little quirks. So just play it super tight. Don't leave anything dangling in the wind, man. Just go and always remove risk. John, who works with us, he always says, he's probably said this 10,000 times, I'm a risk manager first. Always remember that.
I like that. There's nothing wrong with being a little paranoid when you're trading options. That's words to live by. Maybe that's our title of our episode, Paranoid Options Trading. There. But yeah, you're right. People always ask, how come people on the network who've been doing this for a while, maybe we're a little bit cynical, maybe, dare I say it, a little bit jaded, sometimes a little bit suspicious of these things we see out there. Some of us more paranoid than others. I won't say me. You know who I'm talking about out there. But yeah, some of that has just been beaten into into you by the market over time. The more prolonged exposure you have to the markets, I think a little bit more cynical you become as a result. So maybe some words to live by. Nothing wrong with being a little paranoid. Maybe not in your life, but in your trading. Definitely not the worst thing. And you know what else isn't the worst thing? Having a double dose of Options Bootcamp. If you're one of our pro members, you're getting that right now. Everybody else, we'll see you back here next week. Another episode of Options Bootcamp. Stay safe and perhaps paranoid out there, listeners.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.